Now, take a look at the European and American stock markets and you'd think the global financial crisis was a distant memory. Equities have bounced back from their lows in spectacular fashion. The major markets are up 20% in the last 6 months alone. Money is moving from the emerging world to the developed world, the threat of inflation and ongoing debt problems receding into the background. Trouble is, as Philip Lasker reports, those problems haven't gone away.
Trillions of dollars in debt, high unemployment in the US and Europe, and nations on the brink of bankruptcy. It hasn't jeopardised an equity revival.
I think there's time to act, and I think there's also a consensus to act in the United States. The way the election went, a dramatic shift of power in the November election.
Right now, the major focus is the revival in manufacturing across the developed world, driven by a rundown in inventories during the global financial crisis and cheap currencies.
All economies go through cycles, and even if you have headwinds of excess debt or structural problems in some countries, when you come off a cyclical low, driven mainly by an inventory cycle, that overwhelms those structural headwinds for at least a couple of years. Then, once those cyclical impulses fade, then all those headwinds you mentioned correctly then come back into play again.
Also in play are the trillions in stimulus dollars, which are beginning to circulate as confidence grows despite stubbornly high unemployment.
We think the U.S. economy is in kind of a sweet spot right now. Inflation's not very high. We don't expect it to be too bad for a couple of years. Growth is coming on pretty strongly in the U.S. Profit growth has been spectacular.
Last year, for example, it looks like corporate earnings per share, if you like, were up around about 43%. It's still being revised upwards, and it's been continuous upward revision, so it'll probably settle about 44%. This year already looks like it's going to be the order of 15%.
And in Europe, investors are banking on the willingness of countries enjoying a currency-led export boom to rescue their debt-laden neighbours.
12 months ago, people in Germany were pretty reticent about bailing out some of these affiliate or periphery countries because confidence levels were only just building. We've come a long way in 12 months now, and the willingness of Germany to underwrite some of these countries is far greater because they see an overwhelming need to keep the euro together.
It's been a feature of commodity markets as well, particularly record copper prices, which are responding to the improvement in manufacturing and global growth expectations.
We're reaching these levels purely on supply-demand scenarios, plus optimism for the new year that suggests that everything will be okay.
But even the optimists warn that everything won't be okay if governments don't use the upswing to aggressively address the debt problems, because skyrocketing interest rates could be just 18 months away. Australia, though, may have another long-term problem which risks destroying a number of its export industries.
Our terms of trade due to the China industrialisation boom are about 30% above their long-term average. So we'd also expect the A-dollar to average a level 30% above its long-term average. So we see that average shifting up to about 90 cents from the old 70 cents that we had been used to.
If we do, we'll probably have one or two industries in this country and nothing else.
The resources industry, which sustained Australia through the global financial crisis, could eventually be the only sector standing.